Good morning, team, and welcome to today's Monday morning mortgage update. My name is Sean Wohland with the Wohland Mortgage Team, and I'm super thankful that you're watching this morning, and I really do appreciate your referrals and your business. Our motto here at the Wohland Mortgage Team is high performance lending with honor, integrity, and trust. So we appreciate your trust and look forward to working with you this week and many, many more. All right, so let's jump right into today's update. What is happening with the markets? Well, let's jump into our loan spotlight first because this is super exciting. Lender paid rate buydowns. So up until right now, we have only allowed the sellers to pay for temporary rate buydowns. Now, us, Wohland Mortgage Team, we are going to pay for the temporary rate buydown for the 1% below market rate buydown the first year. So if the rate's 6.375, we will pay for the first year to be at 5.375 at no cost to the buyer or the seller. We will also participate in covering some of the cost on a 2-1 buy down so that the seller doesn't have to give as much. This scenario here is built for if the seller is not willing to give anything, but the buyer still wants a temporary rate buy down, we will cover the 1% for the first year. And then on the 2-1 buy down, we will split the fee with the seller. So super exciting. This should help get some people off the fence that are weary about rates. So call me and talk to me if you have any questions on that or any buyers that may need this product. Super exciting. So what's happening in the markets and what happened last week? Here's the last week in review. CPI inflation actually came in a little lower than expected. It was at 0.3 month over month. That's always good for the bond market. Home sales rose a little bit, but not as much as expectations. They were expected to rise by 2.5% year over year, but they were only 1.5%. Still positive, but not as much as expected. The median home price actually fell in September. So median is just what's the most popular price range that's selling now. That's what median home price is. It doesn't mean values. What is the average price of the home that's currently selling now? What is the most popular price range? And that came down a little bit. Mortgage rates dropping has helped that lower price range by getting buyers off the fence a little bit. And on the higher end, rates don't affect purchasing as much. So that actually makes a lot of sense that that has come down. Job markets was slow. The job numbers are a little weak. So that actually gives the Fed more of a chance to cut rates when the employment is weak. So we'll continue to watch that. Job market's very, very important. We'll see what happens with the tariffs. There's some interesting things happening with China and the rest of the world with tariffs. We'll keep an eye on that as well. But for now, inflation is in check and the employment is weak. This is the 26th day of the shutdown now for the government. Not really 100% certain what's going to happen with the economy based on this. It's going to be interesting to see. Hopefully, they'll come to an agreement on this. And there's a lot of politics being thrown back and forth on this, but we'll see how this impacts mortgage rates as we continue. Now, what's happening this week? Monday, we've got durable goods orders. That's things like buying of durable goods like cars, washers and dryers, refrigerators. This is corporations buying them and putting them in for their inventory. So if companies are buying very little, that means that they expect maybe the economy to be weaker. So low durable goods orders is more of a weaker economy, where high durable goods orders is more of a strong economy. Now, we also have a 2- and 5-year bond auction. Those are short-term bonds. We'll see how that comes out today. Tomorrow, the FHFA home price index is coming out. The Case-Shiller home price index is coming out, so we'll see what that looks like. The Richmond Fed manufacturing index. Remember, manufacturing, if it's low manufacturing numbers, that's weak economy. That's good for mortgage rates. So we'll keep an eye on that on Tuesday. Consumer confidence comes out tomorrow as well, as a 7-year Treasury bond auction is happening. Again, weak bond auctions are bad for mortgage rates. We want positive, exciting news. We want people buying bonds. So if there's a weak number of buyers of bonds, that hurts the bond market, which could be bad for mortgage rates. So we'll watch that. Wednesday is the big day, guys. Fed day. What will it be? Will it be 25 basis points? Will he not cut at all? Will there be 50 basis points? Right now, it's basically cooked in the books that it's a 25 basis point change coming on Wednesday. So a 25 basis point cut is what is expected. We'll go over that in just a second. Thursday, jobless numbers. That's going to be a big one. Initial jobless claims and continuing jobless claims are coming out, and as well as GDP, and the ECB rate decision is going to follow us. They're going to do theirs on Thursday. And then Chicago on Friday will come out with the Purchase Managers Index. Again, weak numbers on that, shows weak economy, which is good for mortgage rates. I'm going to be watching all this carefully so we can lock in our customers at the best time possible to get them the lowest rates we can. So here's the probability, 96.7% probability that Mr. Powell will go ahead and cut the Fed funds rate. So what will that do to mortgage rates? What impact will this have? Well, let's look at it. Already a quarter cut is cooked in the books. That's already expected. So the markets have already baked that in, so to speak, to what the current economy is showing. So the bond market has actually gotten better based on this over the last couple of weeks. Everything's already baked in. It's already cooked in the books. However, if we get a surprise like a 50 basis point cut, that is not already built into the market. So a 50 basis point cut could go a couple directions because it's going to be a surprise. We could see the bond markets rally. However, we could see, that's maybe too much. Maybe that could be inflationary. So we could see the markets get disrupted and maybe mortgage rates get worse. So we're going to have to watch that really carefully. As the bond market moves, I'm going to be watching my customers to see if we can lock in maybe at lower rates, or if they start to get worse, we can lock in right away before they get worse on rate sheets. So what Powell actually say is going to be more important than the cut. If they talk about employment being weaker than expectations, that's good. If inflation continues to drop and he talks about that, that's good. And cutting off and stopping the runoff of the balance sheet is a good thing too. Remember, them selling off bonds is bad. It hurts rates. They've been doing that for a while. Mortgage rates were really good during COVID because they were buying mortgage-backed securities like they were going out of style. They were buying them like they were hot item on the shelf, right? And now, not so much. Now, they're selling them off. That's why rates are getting worse. So we'll have to watch that carefully. So here's what we can expect. If employment continues to show signs of weakness, that's good for rates. If inflation continues to drop, good for rates. If the halting of the runoff of the balance sheet, if they're stopping that, that's good for rates. But what would maybe hurt interest rates when the Fed talks? If he talks about employment being strong, that's bad for rates. If he talks about he's worried about inflation, that's bad for rates. If there's no cut at all, that would shock the markets, and that's bad for rates. That means he thinks the economy is super strong, doesn't need another cut. But again, expectations are we're going to see a cut, so expect that as we move forward. So what's happening with mortgage rates? Well, this is actually really, really important. I want to go over this in depth. If you look right here, this Fibonacci line going across, this arrow is pointing to it right here. We don't want to go above it. For the last couple months, we've been trying to get above this Fibonacci level. We tried here, we went right above it and came back down. It went right up to it, came back down. Went right up to it, came back down. Went above it, came back down. Stuck here, went above it, came back down. Went above it, came back down. Went above it, came back. See the trend? Then we lost a lot. We started to gain ground. We got up here. We wanted to go up to it. We wanted to go through it. It came back down. We wanted to go through it, came back down. We wanted to go through it, came back down. We went through it, but came back down. We want to go through it, came back down. Notice the pattern. This is a stubborn little Fibonacci level. We haven't been above this level in a long time. So a lot of people think mortgage rates are going to be stuck right where we're at, and this is in the low sixes. So we really need to get above this Fibonacci level to really get better rates. Even more important is the 10-year. So let's look at the 10-year, because if we can get under 4, we'll see lower rates. But if we don't get under 4, we're not going to see rates in the 5s. So here's where we are on the 10-year. We started to show really good signs back in early October. The 10-year fell. When the 10-year falls, mortgage rates fall. We saw a nice little run all the way down, and look where we ended up. We were in the 3s. We ended up right at the 3.96 range, and then we lost it all, and now we're above 4 again. So If we can get under 4, that's really good for us because that shows signs. But remember, if you look over here, we tried to get under 4 back here, it failed. We tried to get under 4 back here, it failed. We got it this time. Exciting, right? We came back and now we're failing. So we need this to be under 4 to see rates in the 5s without any points. So let's hope that happens. Say a little mortgage prayer for the 10-year to drop below 4 and stay there. That's going to be critical. We'll see what happens with the Fed cut to the 10-year. That's going to be really important to watch. So here's mortgage rates. Low 6s, as you can see, kind of in the red. We're a little worse today, but still overall good. 30-year fixed in the low 6s, 15-year fixes in the 5s. That's exciting. So if you have some people that can stomach the higher payment, they will get rates in the 5s. It's about 1/3 higher in payment to do a 15-year fixed, but it's half the term. So always a beneficial piece to do, beneficial loan to do a 15-year. 30-year jumbo in the low 6s. ARMs are seeing better rates. So we're seeing ARMs in the 5s, and then FHA is in the 5s as well. So some good news there, guys. Now, FHA, this is with the good rates. Remember, if you have lower rates, you will see higher. If you have lower credit scores, you will see higher rates. This model right here is based on a $500,000 purchase price, 25% down, 780 credit score, single family detached, planned unit residence, or single family home, not condos. So this is like the perfect borrower. This is the rates they can expect. But that's our update for today. Thank you, everyone, for joining us. We are the Wohland Mortgage Team. Here's my cell phone. If you have any questions, feel free to call me. Otherwise, have a phenomenal week, and we will be in touch.